Hello financial fans, welcome back to another stock analysis. Today we'll be covering Cisco Systems stock ticker CSCO. Cisco Systems is a multinational technology company that specializes in the design and development of networking equipment, software, and services. The company was founded in 1984 and is headquartered in San Jose, California. Cisco's primary business is the development and manufacturing of networking hardware, including routers, switches, and wireless access points, as well as other networking products such as security and video surveillance systems. The company also provides a range of software solutions for network management, collaboration, and analytics, as well as a consulting service to help businesses design and optimize their network infrastructures. Cisco's mission is to enable its customers to securely connect and collaborate with anyone, anywhere, at any time, using any device or application. The company is widely recognized as the leader in the networking industry, and its products and services are used by businesses, governments, and consumers all over the world. They're currently sitting at a $208.6 billion market cap, and in 2022 they generated a revenue of $51.6 billion, and the dividend yield is currently sitting at 3.07%. 53% of their revenue comes from their infrastructure income streams, 28% from services, 12% from applications, and 7% from security. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors in a scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone down over the years, going from $4.1 billion in 2013 to $3.6 billion in 2022. The average decline in EBIT during this period was 1.4%, meaning a 5% increase in the margin of safety. The margin has also gone down over the years, going from 23.65% in 2013 to around 20% in 2022. The average decline in margin was 1.7%, meaning another 5% increase in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from 68 cents a share annually in 2013 to $1.52 a share annually in 2022. The average increase in dividends annually during this period was average of 9.5%, meaning a 5% deduction from a margin of safety. This with a payout ratio that is sitting at 55.7%, meaning there is still some room left for them to increase their dividend further, but it does not qualify for a deduction in a margin of safety, so in this case, no change. The final two ratios that we'll be looking at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. As you can see for Cisco, their cash position is greater than their debt, meaning they can pay off all of their debt just using their cash. This indicates a 0% debt to EBITDA ratio, meaning that Cisco has no debt, and this is a 5% deduction in a margin of safety. The return on invested capital is a very solid 14.3%, meaning another 5% deduction from a margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Cisco. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Cisco going from 2013 to 2022. The average increase annually in free cash flow during this period was 1.17%, and I'm projecting expected growth rate of only 1% over the next 10 years annually in their free cash flow. And with this percentage, we can determine the future free cash flow for Cisco and determine a terminal year valuation using a 3% perpetual growth rate and a discount rate of 8.5%. This gives us a sum of free cash flow of $198.4 billion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $208.2 billion. All we have to do to get a discounted cash flow price per share is to divide it by the amount of shares outstanding, which gives us a discounted cash flow price per share of $50.79, which is pretty much exactly at the current price, with only a 2% or 2 cent upside rather. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends during this period was 3.6%, and I'm projecting expected growth rate in dividends of 4% in the future in dividends, because I think they can achieve this. And I will once again be using a discount rate of 8.5% in this valuation. And out of this model, we get a price per share of $35.13, which is almost a 31% downside. The third model that we use is Graham's revised valuation formula. And in this model, we'll be looking at the earnings per share of Cisco, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we go by the theory that the PE of a company with no growth is always at 7. And looking at all of these metrics, we get a fair value out of this model of $35.49, which is a 30% downside out of this model as well. The fourth model that we'll be looking at is the multiple valuation. In this model, we look at similar companies to Cisco, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry that Cisco operates in, which in this case is 22.17. All that's left to do to get our fair value is to multiply by the earnings per share that Cisco is generating, which is $2.73 a share. And this gives us a fair value of $60.53, which is a 19.22% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean. And the metrics we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield, or the average dividend yield of the past 5 years, and the average yield during this period was 2.92%, and the current yield is 3.06%, meaning that on this metric it's currently undervalued since the dividend yield is currently higher. The PE ratio, on the other hand, is currently higher than the average it was over the past 5 years. Over the past 5 years it was 16.73, and the current PE ratio is 18.6, meaning that it's currently overvalued on this metric. We get a fair value of this model of $49.44, which is a 2.62% downside out of this one. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $46.27. Without adding a margin of safety, we would still get a downside of almost 9%, but we have determined our margin of safety earlier, using a standard margin of safety of 25%, deducting about 5% for the debt to EBITDA, adding 5% for the EBIT growth, adding another 5% for the margin growth, deducting about 5% for the return on invested capital, and another 5% for the dividend growth, leaving us with a margin of safety of 25%. Applying this margin of safety, we get a fair value of $37.02, and with the current price of $50.77, this is a just over 27% downside. So in this case, it would be a sell. If there's any other dividend companies or other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.